A life cycle costing analysis is made to facilitate a decision. Which alternative is the best choice from a long-term perspective? To help you make this type of judgment, this module introduces three key financial indicators: net present value, NPV, discounted payback time, DPBT, and internal rate of return, IRR. But first, there's one important concept we need to clarify: the time value of money. The time value of money is not the same as inflation. Inflation is the rise in the general level of prices for goods and services. The time value of money is the profit that could have been made if that money had been invested over a period, and therefore that time value is lost if the money is not invested. The three key financial indicators introduced in this module, namely net present value, discounted payback time, and internal rate of return, all make use of the time value formula. PV is equal to FV divided by 1 plus the discount rate I to the power of the number of years K for which a discount rate should be chosen. Determining that discount rate I is a difficult but important decision. You'll have to decide whether you will or will not include inflation in your analysis. If you don't, you'll calculate the time value of money with a nominal discount rate. If you do, you'll use a real discount rate. Future rates of inflation or possibly deflation are uncertain. We advise you to include an estimate of it for inflation so that you use a real discount rate. Many specialists agree that the real discount rate should reflect the investor's opportunity cost of capital. Capital employed to make an investment in energy efficiency measures does not come for free. Either it's borrowed capital, debt, or it's owned capital, equity. Both debtors and shareholders will expect a certain return from their money, and that return is the opportunity cost of capital. An accepted benchmark for the opportunity cost of capital, and thus for the discount rate, is the weighted average cost of capital, abbreviated as WACC. The weighted average cost of capital is the rate that your company pays on average to the owners of the capital it uses. The great challenge in calculating your company's weighted average cost of capital lies in determining RE, the return that your shareholders expect. A popular approach among financial experts is the capital asset pricing model, CAPM, in which RE is determined using the formula on this slide, where R0 is a risk-free rate, beta is a company-specific factor, and RP a risk premium of typically 3 to 5%. Explaining the capital asset pricing model in more detail will lead us too far. Therefore, we limit ourselves here to saying that WACC calculations are not an exact science. If your company is publicly listed, they should have an estimate for the company's WACC. But if you can't get help with this complex financial analysis, you may have to take a pragmatic approach. The absolute minimum WACC is around 4%, the so-called social discount rate applicable for long-term social planning. In general, a WACC is seldom below 7% and it's seldom above 20%. The WAC of similar companies active in the same industry and with a similar risk profile can be indicative, as WACC is somewhat comparable within industries. Some industry-wide estimates for WACC can be found on the website, that's wacc.com, for instance. But in our example company, Leonard took a pragmatic approach. By looking at the WACCs of major companies in his sector and adding a risk premium, he came up with a WACC of 9.5%. To make life cycle cost comparisons, we use financial indicators. The net present value, NPV, of your energy efficiency project is the most important key financial indicator. It is defined as the sum of the present values of the individual cost components, whereby each instance of each cost component is discounted according to the year in which it occurs. In the context of LCC, NPV is a way to evaluate the total long-term cost of each alternative, or in other words, the total size of the iceberg. NPV allows you to compare your different options in monetary terms. Let's presume that for one of the alternative investments you are investigating, that you have calculated all relevant cost components so that CK is the sum of all costs occurring in the year K and C0 is the initial investment in year 0. Then the net present value of this alternative can be calculated using the formula on this slide. NPV can be calculated directly in Microsoft Excel by applying the function NPV. By calculating net present values for each of your alternatives, you will get an idea of the total cost impact of every alternative across the full time horizon. The most attractive alternative will obviously be the one with the lowest NPV and therefore the lowest life cycle cost. By calculating the NPV for the base case and comparing it to the NPVs for your alternatives, you can enumerate the savings that can be made from your energy efficiency project. Where NPV is calculated in money terms, discounted payback time is a calculation in time terms. The central question is, what is the payback period for the investment? A simple way to find an answer is to subtract year by year the realized savings from the initial investment cost until you reach 0. That's the break-even situation, and the corresponding period is the payback time or regular payback time. For example, if you invest 1,500 euros in year 0 and from the first year you save 500 euros per year, the regular payback time will be 3 years. Intuitively, you would prefer projects with a shorter payback time, but should you always choose the project with the shortest payback time? The answer is actually no. Often the DPBT and NPV criteria will rank your alternatives in the same way, but in some cases there might be differences between DPBT, which has a shorter time horizon, and NPV. NPV takes into account all factors over the complete time horizon, while DPBT looks only at the costings and savings that occur in the years before the break-even point is reached. It neglects everything that happens afterwards. The third key financial indicator to express LCC is the internal rate of return, IRR. The IRR is the discount rate that makes the NPV of your project 0. In other words, by calculating the IRR, you determine the maximum discount rate that would still allow the investment to be profitable. A high IRR means that the project is more interesting. In general, the IRR of a particular project should be greater than the cost of capital, WACC, in order for the project to be worth considering. The easiest way to calculate IRR is using the IRR function in Microsoft Excel. Some companies have a benchmark B and will approve a project only if the IRR exceeds that benchmark. In some cases, this benchmark is the same as the WACC, so the project is only approved if it can cover the cost of capital. In other cases, the benchmark is higher than the WACC. In that case, investment projects are only approved if they exceed the expectations of the capital holders and effectively add value to your company. IRR is useful to evaluate single energy efficiency projects because it helps answer the question, is this project worth investing in? Many companies use IRR for comparing and ranking different alternatives. However, it is not as good as NPV for these questions because IRR tends to favour projects with less capital investment in the beginning, while NPV balances costs that occur at different moments by discounting the actual cost of capital and thus permits you to make a better, more comprehensive decision. That completes our overview of the three main financial indicators. But before finishing, please look at this graph. It illustrates an important weakness in IRR as a decision-making tool. The blue curve is the net present value if the ABC Petrochemical Company, from our example, invested in Alternative A. At 27.1%, Alternative A offers a superior internal rate of return to Alternative B, the red line, which offers an internal rate of return of 25.2%. If you just consider internal rates of return, alternative A is the superior investment. But the NPV profile tells a broader story. It shows that at virtually every other discount rate illustrated on the graph, alternative B has a higher NPV. This illustrates that NPV is preferable over IRR when ranking and comparing projects.